Great to have you both with us. And Chet, starting with you, loans are floating rate instruments that'll see coupons expand as risk-free rates rise. How is the retail demand for leveraged loans impacting the loan market?
Well, there's a pretty strong correlation between the 10-year and yields as well as inflows into retail loan product. And so if you go back in time and go back to the 2014 timeframe or 2018 timeframe, similar to today, effectively, when yields started to rise, and you take a look at what retail loan inflows were actually doing, basically prime funds were taking in, at their peak, probably in the 2014 timeframe, about 175 billion of total assets. You fast forward from there to about 2018, same thing was happening. Prime funds were probably closer to about 185 billion or so of total assets. Then compare that to today, you're starting to see obviously talk of inflation, the 10 years starting to rise. And you're actually seeing prime funds at about 135 billion or so of assets. And that actually doesn't include ETFs, which are, if you take the top three or so, are probably around 13 billion. So if you sum that up relative to the overall loan market, what you'll see is you're probably at about 20% of the loan market in 2014, maybe about 15% in 2018, and then today, maybe about 10%. And so I point this all out to just say from a technical perspective for the loan market, I mean, there's definitely potential for tailwind there in terms of that retail bid as the 10-year starts to go higher.
And Chet, Libor is going away. How are you thinking about the change in Libor to an alternative rate and its impact on the loan and CLO markets?
Yeah, so I mean, basically taking a step back and thinking about what kind of precipitated this with Libor, there was concern, of course, in the past that Libor itself was a manipulated rate, potentially, of course, it was fixed by the banks. So the idea was to transition over from Libor to some other market-determined rate. And so far, most of the commentary has been around SOFR, which is the secured overnight financing rate, basically based off of Treasury repo. And so a little bit about timing, about how this could potentially work and play out. Basically, by the end of this year, and actually starting into 2022, any new loans or any new CLOs are going to have to basically reference that new alternative rate. And again, it's most likely going to be SOFR. For avoidance of doubt, I think through June of 2023, you're still going to have publishings of 1 month and 3 month Libor for all those loans that were issued prior to 2022. Now, if we take kind of the markets separately, think about the loan universe and then separately the CLO universe, the two are quite tied together. For the loan universe, credit agreements had been referencing some form of fallback language for quite a while now. And that documentation has become a little bit more robust over time. So much so even now, as you see new issue enter the market, something like 90% of new loans are coming out with some of the best practices from a fallback language perspective. Now, as it relates to the CLO market, of course, what we care about there is that simply the underlying loans effectively match what is within the CLOs. So as the loans go inside of the CLO portfolio, we just want to make sure that the CLOs actually match that underlying reference rate. And so the way CLOs had been documented in the past and this year, we had a very good refi reset year this year for CLOs. That language basically says you've got a threshold as soon as all of the loans in the portfolio, I should say, as soon as 50% of the loans in the portfolio reference that new rate, then the CLO trips over onto that rate. So our expectation going forward is that as long as this transition occurs relatively quickly, that mismatch potential between rates in CLOs and rates in the underlying loans won't become any sort of an issue. And if you think about kind of where banks sit in this whole process, banks don't want to have to deal with the amendment process loan by loan. The expectation is that there's going to be a push as you head into 2022, that a lot of the underlying corporate loans are going to simply refinance out straight into SOFR versus waiting for some type of fallback. So we think ultimately this process will work relatively smoothly. I think that makes a lot of sense, Scott. And I think, it's interesting, if you look back in time, I think you go back 40 years and you take a look at sovereign kind of returns. I think if you look back on a 5-year rolling return basis, basically you've got negative real returns after inflation in a number of sovereigns. And so it wasn't enough that you got the call right to be in risk-free paper and that you didn't get hurt by rising yields. I think that what you actually ended up getting hurt by was inflation. And so I think that's right. I mean, basically from the standpoint of how you combat that for carry is with spread. And, Scott covered a lot of those items. I mean, whether it's leveraged loans or high yield bonds. One I would add to that I think is quite compelling, actually. And there's now, more retail product out there to address it, is effectively CLO tranches. Basically, tranched out liabilities that pretty much reference the underlying leveraged loan market, which is a $1.3 trillion market. And remember that CLOs are effectively about 63% of the loan universe. So it's a pretty healthy representation of the loan market.
Chet, reports about the risks in the loan market grab headlines. Are credit agreement documents that govern individual corporate loans in worse shape now in terms of permissiveness than they were in 2019?
Well, I think first things first, I think what I would want to say is that, look, when we take a look at credit and when anyone takes a look at credit, we think that it's important to underwrite credit for cash flow and Porter's five forces. What it comes down to is you want to make sure that the company is in a good position and has the ability to cash flow appropriately to service their obligations and to pay for their maintenance CapEx at a minimum. But that said, thinking about the market from the standpoint of covenants, whether that's bond indentures or loan credit agreements, I want to back up a second, just talk about kind of how the market has progressed over time. First of all, bonds have something called incurrence tests or incurrence covenants, I should say. Similar to loans. Loans also have incurrence tests as well. Loans in the past actually had maintenance covenants too. Now, tackling them one by one, for incurrence tests, basically what that is a company gets tested to determine whether or not they want to take an action. So they have to pass the test to take an action. With regards to maintenance covenants, that's something that's tested in the past on a quarterly basis. And for that, it's not a matter of incurrence, and it's not a matter of doing an action. It's just a matter of getting tested quarterly. Well, maintenance covenants over time have generally fallen away, but I oftentimes get the question if covenant light means there are no covenants whatsoever, and that's simply not the case. Across bonds and loans, you still have an incurrence tests. Now, one thing I want to point out in terms of how covenants have progressed over time, basically, the market will ebb and flow with supply and demand. While you have seen maintenance covenants fall away, you have seen incurrence covenants still remain in capital structures, in credit agreements, and bond indentures. And the important point is as that supply and demand ebbs and flows, you'll see some variation in what sponsors can put into documents. So, for example, there are times when particular provisions are taken away. At times like in today's market, for example, I'm seeing plenty of opportunities where some of those provisions have been put back and those protections have been put in place. And so that's kind of a moving sort of ebb and flow in the market. Yeah, I think that's exactly right. And I think, one thing I try and point out to people looking back in the past, the example I give is think back to like the 2014, 2015 timeframe. Think about when oil prices fell apart. I mean, you could have had a full slate of covenants. And that wouldn't have necessarily saved you from the fundamental degradation that occurs in the business. In that case, you cared about cash flow and asset value. And so I think what I'd point out is, you still ultimately you have to underwrite the credit. The rest are generally nice to haves. Certainly with the maintenance covenants, we certainly take a close look at the incurrence covenants and make sure that we're comfortable with the risks that we're taking. I think that's absolutely right. I mean, expected default rates are going to be low. And from a fundamental perspective, the high yield universe is actually looking relatively clean in terms of balance sheets. And as Scott had mentioned, runway, as well as liquidity. Coming off of COVID, a lot of companies had kind of puffed up their ability to get liquidity. And I think there are a couple of other interesting points to note. Now, I'm not going to claim that in any way I focus solely on the ratings agencies. But if you were to just simply look at it from the standpoint of ratings and go back to the 2000 timeframe, and then fast forward to generally today, what you'll find is for all those credits that are rated BB or split BB, basically just a shade below investment grade, the upper end effectively of the high yield universe, you're probably about 30% of the market back then. Today, you're closing in on something like 57, almost 60% of the market. So if we were to simply use the ratings agencies as a proxy, you can get to pretty happy place in terms of the quality level of the overall high yield universe. The other thing worth noting is for a lot of the fallen angels that you saw post-COVID, those are companies that have a lot of levers that they can pull from a cash flow perspective. From a burn perspective, I mean, they have capital structures with coupons that are a lot lower because they're previously investment grade. And with those extra levers, perhaps dividends that could be cut that they could use to focus on paying down debt, you can get an acceleration of delevering as they try and move back up into investment grade status. So we think that's another potential positive. And then finally, just looking at it purely from the standpoint of growth of debt, just a generalization, but if you take a look at the investment grade market, take a look at high yield as well as leveraged loans, you've got an interesting dynamic that's played out with regards to kind of lows in gross leverage to call it today's levels. And what you'll see is, interestingly, the investment grade universe has actually raised leverage by about 80% or so. A high yield universe, only about 35%. The loan universe, about 65%. So on a relative basis, you can see that if anything, probably investment grade has taken on a little bit more risk throughout COVID. And Scott, I think you mentioned this before, but duration in IG at 8 years, roughly half that now in high yield. Even if you dip down from IG down into, say, double B, which will probably be some of the longer debt out there, include some of the fallen angels, you're still a shade below 5 years. So to your point, you can pick up some extra spread, but markedly reduce that duration risk. And of course, that's not even including going into single B credit. Given those good balance sheets that we're talking about and good credit metrics, we can cover more about that. But you're basically you're benefiting. You're picking up carry without taking that interest rate risk.
Yeah, Chet, how would you sum up your view of the current quality of the loan market in terms of credit risk?
Yeah, I mean, I think coming off of COVID, some interesting things have happened here. EBITDA growth has been great. EBITDA margins have been great. And this is specific to the loan universe. If you think about what happened, we entered an environment that no one really thought was going to happen. We had basically zero in revenues. Companies went through a phase of cost cutting. And what I'm seeing just anecdotally in some companies now is as revenue comes back, management teams are finding a way to effectively do success-based cost incurrence. What that means is revenue comes in the door, then they incur the cost. It's not done proactively. And so I think that's really helping EBITDA margins out quite a bit. But then fundamentally, just taking a look at the loan space, if you look at those public filers that are out there and just look at enterprise values, think about that cushion that sits below the leveraged loan, which is senior secured in nature, of course, that couldn't also include a cushion of unsecured bonds. Basically, those enterprise values have risen materially heading into the fourth quarter of 2020 and into 2021 as well. And then a slight proxy for that, if you were to take a look at something like, say, the Credit Suisse Leveraged Equity Index and take a look at market cap per issuer, what you'll see is over time, effectively the same things happen. Market cap per issuer has generally risen. So you're getting a better cushion behind loans. So that's been a definite positive for the loan market. There's a couple of other factors I think are equally surprising. Basically stats around short-term debt. If you look at short-term debt as a percentage of total debt, we're at record lows right now, roughly at about 3%. And I say record, going back about a decade effectively. And then if you take a look at the metric in terms of cash relative to short-term debt, basically measures of liquidity, we're at about 300%. Same concept, go back 10 years. Those are stats that are extremely positive for the loan universe. But then take a step back. I mentioned the ratings agencies. Again, we don't necessarily look at credit purely from the standpoint of ratings. You do have to keep in mind, though, that a large part of the loan market is controlled by CLOs, about 63% or so of the market, and they are to some degree ratings driven. But if you take a look at the loan universe, what you're going to find is we've been in this pretty large upgrade wave that's been lasting for a while now. And as that credit quality improves, companies have the ability to basically up tier from a coupon perspective, reduce some of that fixed cost of theirs. Yeah, I think that's absolutely right. I mean, I would reiterate that point about active versus passive. I think the evidence would show, and this has been an ongoing fact, that active management in fixed income, to some degree, actually, you're not seeing the same evidence with equities, but in fixed income, whether it's high yield bonds or leveraged loans, active management does work. I mean, you think about the way some of these passive indices are created. Oftentimes it's as arbitrary as how large is the tranche. And usually that's pretty much a proxy for liquidity, but you're inadvertently taking on other risks. Perhaps it's excessive leverage in that particular name, or perhaps you're concentrating a portfolio in a passive index of LBOs. And that may not be what you intend. In terms of other vehicles, I think are interesting to consider, and it's true really across fixed income, is closed-end funds. That could be one other type of vehicle that would be interesting to retail investors. Closed-end funds are basically fixed pools of capital where the shares actually trade based upon supply and demand. And so as a result, they can trade at a premium or a discount to NAV. And so I think that could also be interesting. You can oftentimes find, based upon changes in sentiment across the asset classes, some of these closed-end funds trading at discounts. And that can augment the yield that you're getting on the underlying portfolio. It can also help out with liquidity.
Chet, any other thoughts around the types of investments and loans that you would recommend for investors?
Well, I think it largely rhymes with what we talked about for high yield conceptually. I think the thought of staying in an actively managed fund matters. As I think back to some of the passive funds in the past on the bank loan side, I remember a couple of names, in particular iHeartMedia and Toys R Us, which were actually in some of the larger passive indices, I believe it was in some of the ETFs. And that was unfortunate. Of course, some of those larger names, LBOs, actually headed into bankruptcy. And any amount of active management could have probably pulled this out of the portfolio and optimized that. I think that the same thing is true, as I mentioned before, in closed-end funds. That'd be an interesting vehicle to consider. The other thing I would suggest, and it's rather new in terms of opportunities on the retail side, is also CLO tranches. We talked about that before, effectively as, if you want to call it, the derivative or a proxy to the corporate loan market. Interestingly, for the ratings there, you're actually getting potentially outsized yields. And as Scott had mentioned, sometimes these funds could even be used as a trading vehicle. There are times with CLO tranches, depending upon sentiment in the market, that you can also use them to that effect. But generally, because of the floating rate nature of these products, whether it's loans or CLO tranches, and because of the availability to retail investors, they can make sense from an inflation hedge perspective. Yeah, I would definitely echo what Scott said. Certainly from an asset class perspective, leveraged loans. And anecdotally, as we, and actually CLO tranches as well too. And then after that, if high yield bonds, we talked about some of the concentrations in double B and what that could mean from a fixed rate perspective if rates were to rise. But just anecdotally thinking about some of the names that have reported here recently, as we look at 2021, coming off of COVID, it has been interesting. You have seen prices rise for raw materials. You're already seeing it flow through, of course, for freight. That's a big one across a lot of these companies that are selling particular goods. And what we're seeing is as price increases are going through, to Scott's point, companies are experiencing pricing power. And so we're seeing that flow through to EBITDA margins as well. Yeah, I think Scott's exactly right. I mean, you go into the back half of this year, I suppose you might have some growth concerns, but we'll see coming off the first half of this year. But yeah, I mean, when you look at what happened with COVID and you think about the industries that got hurt, you effectively went through a mini credit cycle, right? We saw energy effectively fall apart when demand, of course, fell almost completely off. You saw the same thing pretty much happen with retail as well, with bricks and mortar. And so what you effectively had happen is you wiped clean some of those names that were some of the weakest. And this is kind of a theme that is true across loans and high yield bonds as you go back in time, called over the past 20 years. While it's true that you have macro events and you have things like the financial crisis or you have the Asian bond crisis in the late 90s, and it's true that generally affects everything in the market, you also have mini cycles. You might have telecom, you might have the airlines, you might have autos that are basically experiencing stress and distress away from a larger macro cycle. And so we effectively experienced that here recently, the same way that energy did back in 2014, 2015. And so post that mini cycle, post the ability of the Fed to step in and largely help investment grade companies, but effectively everyone, you've got balance sheets, as Scott was talking about, that look quite good. And so you've got runway, great interest coverage. So this could be the start of basically that new cycle.
A mini and accelerated cycle there. Now, Chet, what are the supply, demand, and technical dynamics of the leveraged loan market and the follow-on effects with CLOs?
So, and I'd like to address this more so than anything from a standpoint of technicals, especially as it relates to CLOs and the loan market. If you think back to what I said before about the retail investor, I'd mentioned there's probably about 135 billion in prime funds, maybe about 13 or so in ETFs. In terms of representation of the overall $1.3 trillion loan market, it's still relatively small compared to the past. So that's experiencing inflows, as we talked about, because of inflation. If you look at the CLO market, it's been just an amazing year from a new issue perspective. You've probably seen so far year to date about, I think last numbers might have been in the 120 to 130 billion range of total issuance. And so from a demand perspective, things are looking quite healthy. From a supply perspective, you're actually seeing some of that supply start to tail off here as you enter into the end of the year. Probably have a robust month here, and then as you tail off into the fourth quarter, you're going to see things start to slow down just a tad. And as a result, you might end up with a little bit of an imbalance. And from a technical perspective, that could end up being very strong for leveraged loans. So if you imagine that you could have any type of a pullback here, again, from a technical perspective, for an instrument that is quite well hedged from a floating rate perspective, you could see a sustainable bid for the asset class.
Chet, we know that the CLO market itself is driven by the cost of funding versus the yield that can be earned on the loan CLOs buy. And we also know that the loan market is largely driven by the CLO market health. What are your thoughts on the CLO AAA market and dynamics around supply and demand for that instrument?
Yeah, and it's an important topic. I mean, the CLO AAA part of the market is really the lifeblood for CLOs, given that it's currently about 63% of the capital structure of CLOs. And of course, as we talked about before, it's a large part of the leveraged loan market as well. So kind of where CLO AAA goes, kind of goes everything else. It's just a chain, basically. And so when you think about some of the idiosyncratic issues surrounding CLO AAA, you can start to see how it's kind of in a special class all of its own, even within structured product. So with CLO AAA, what's particularly unique about it is the bond indentures actually are pretty non-standard in nature. They're issued 144A. They're not typically in indices. And something that's unique within even structured product is they're effectively actively managed, which of course we've talked about is an important part of the leveraged finance market, is to actually be an actively managed product. But as a result of those things, it doesn't necessarily attract the buyer base that one would expect as a result of kind of those oddities of the market. And so talking a little bit about kind of where the market is at today, and then relating that back to kind of some of the differences or the uniqueness of the CLO AAA market. If you look at who takes part in that from a buyer base perspective, you've got the treasury functions of bulge bracket banks as being probably number one buyer. You've also got insurance companies. And as you go to the COVID times, you think about going through the second quarter into the third quarter, a lot of those treasury functions effectively stepped away from the market. And in came actually a larger proportion of insurance companies. So right there, starting in the third quarter of 2020, heading into the fourth quarter, you actually saw a nice bit of diversification into the buyer base. And we want that. We want to see more breadth and depth to that market. And that continued heading into the first quarter of 2021. But something kind of silent was going on in the background that's equally interesting. And I'll tie that back into kind of the oddities of the CLO AAA market. And that is that you actually saw a number of asset managers step in and buy these tranches as well. And the reason I say it's important is because for all those reasons that the CLO AAA market is so unique, these are managers that are going to take the time to understand the customized documents that differ from manager to manager, from deal to deal, and better be able to price that debt. And of course, every additional buyer that you can bring to the market helps that spread fall, which is obviously positive to the arbitrage for CLO, basically the difference between what you earn on the assets in the CLO and your cost of liabilities in the structure. And so we think that is going to enhance the stability in the CLO pool. And I think actually, interestingly, there's now a retail product on the Clo AAA side. So retail investors have the ability to partake as well. And it's worth noting, I mean, I don't think I mentioned this before, but from a spread perspective, Clo AAA relative to other structured product AAA, as a result of some of the reasons that I talked about, trades wider. And so it's definitely attractive for this buyer base. Yeah, I mean, I would echo that basically. One thing I would add to that is to consider the fact that when you look at the two markets, there are some differences in terms of composition by industry. So as an example, in the loan market, you have less of energy. I would think it's about 3% of total exposure versus the high yield market where it's closer to about 12% of total exposure. Vice versa, if you take a look at, say, the tech side, in technology, for example, in the loan universe, I believe you're somewhere around 13, 14%. So you definitely can take views also on the overall index based upon how or what you want to express. If you think energy is going to be particularly high beta, particularly the downside, because of course bonds can't trade materially above par, then you would of course avoid high yield.
Of course, structurally, CLOs have changed from pre-Great Financial Crisis. Chet, what are your thoughts on what makes them more resilient now, if at all? I mean, what does that mean for the loan market?
Well, I mean, right off the bat, just in terms of some of the major differences, CLOs post the Great Financial Crisis are less levered. So they're basically about 10 times levered versus quite a few structures pre-GFC that were probably closing in on 14 times. But there's a number of other major differences. One of those is ability to hold bonds. I mean, that has recently reversed here. You are seeing some smaller bond buckets creep into CLOs. It can be additive based upon some of the callability features of loans and based upon where high yield bonds could be in the future, particularly senior secured. The other thing is for CLOs pre-GFC, they had the ability to hold other structured paper, and today they can't hold structured products at all. The other thing is, from a structural perspective on CLOs, if you take a look at subordination in the capital structure, there's actually, if you compare a double B tranche in today's capital structure compared to, say, a triple B tranche pre-GFC, they effectively have the same subordination. So that puts double B investors in probably a happier state of mind in the sense that they have better value effectively below them acting as a cushion. And the last and final point that's actually pretty material has to do also with the capital structure. If you take a look at the AAA in these structures, it's about 63% of the capital structure today versus pre-GFC deals that were probably closer to about 73%. And so if you think about the possibility of a CLO in its natural state, potentially tripping a test and right-sizing itself and paying down some of the liabilities in the top of the capital structure, think about how on average CLOs are paying out like a 4% coupon on a quarterly basis. If you redirect that towards paying down debt, it actually does a lot more to delever today's CLO than it does a previous pre-GFC CLO. And why is that good? Because if you basically shut off cash flows to the equity of a CLO, you can turn them on a lot quicker with a post-crisis deal. And so to sum kind of all of this up, you also have to talk about the state of the environment and how that's also different. So if you go back to the pre-GFC times, and if you take a look at how much of the market was in, call it TRSs or market value structures, estimates place that probably at about 300 to 330 billion back then, which is a very large swath of the market. And of course, as loan prices fell, and back in the GFC, loan prices actually touched into the high 60s. A lot of it was due to this technical unwind for these market value structures. And if you look today, you just don't have that dynamic anymore. With CLOs, in the overall loan market, you might have about 100 billion or so of total TRSs and market value structures, effectively warehouses operating to launch CLOs themselves. But I think one important distinction to make, even with that exposure in the market, is if you take a look at how much equity is backing warehouses today versus pre-crisis, it's truly night and day. Today, you've got material equity. Pre-GFC, you may have had no equity, or the banks may have actually come with that. So, pre-GFC, it was possible a manager would walk away from the deal and just simply let it unwind. And of course, the banks didn't want to be holding those assets, and so they might have fire sold them. Today, it's a different prospect. Use the COVID era as an example. There were a couple of warehouses that unwound, but it wasn't done because of the banks. It was done at the discretion of the manager, and it was to actually take the assets in-house. And so even during something as a global pandemic, you can see how that technical unwind did not impact the loan market in the same way it would have in the past. Yeah, and we want those debt holders happy. I mean, ultimately, the safer they feel, the better they feel about their capital at risk, the more likely it is that they're going to engage the market at spreads that are conducive to see the CLO market grow and thrive. Yeah, I think that's right. I mean, if I hadn't said already, I do think that this is effectively like a golden age in credit. I mean, if you take a look at, all the comments that we've talked about today with regards to balance sheets, and where we are in the cycle across all of leveraged finance, whether it's loans or high yield, it certainly feels like the asset class has the ability to weather what's going to come next. So definitely feel like this is a great trade from a carry perspective, whether it's from the standpoint of loans or even bonds. Definitely more of a preference towards loans and CLO tranches. But as a whole, we think the space could be pretty good from the standpoint of guarding against inflationary events.